Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, 5/1/25. We're into May already. We're filming Thursday afternoon because I am on the road on Friday. Let's take a look at where we sit. Positioning, positioning, positioning. We discuss this all the time. We saw at those post-Trump tariff trading days some extreme negativity, and we mentioned on the video some of that negativity on the negative momentum reaching levels not seen since the first 10 days of COVID back 5 years ago. So those types of extremes do get solved. We don't know where they get solved from, but they've begun to be solved. So now that we've traded back up towards some of the areas in the equity markets that you had breakdowns from, things may get a little tougher. Nice day today. Microsoft, wind in the sails. We'll take that any day. In our tactical trend account, Microsoft's our second largest equity position. So you've heard me complain the last couple of months about 2 steps forward, 1 step back. Certainly the business firing on all cylinders, and some of that price action bodes well for this second quarter for Microsoft. But what it did was take some of the angst off of technology. And you've seen the rest of tech trade in sympathy to the positive side with Microsoft. I mentioned last week, we're favoring software versus semis. That doesn't mean we don't like semis, but we do have a concern on supply chains, and most importantly, tariffs. Much easier to do business with software than it is shipping semiconductors. So software, nice bid. While that's true, I wanted to bring up a sector chart that we spend an awful lot of time at on the equity side. I want to see where we sit today in terms of favored sectors versus unfavored sectors. Keep in mind, we try to overweight favored sectors and underweight or eliminate unfavored sectors. Now, there's always a gray area of improvement. When does a poor performing sector start to improve? We keep an eye on those numbers in the middle of the square to give us an idea if any specific sector is gaining or losing strength or buy signals. So right now, communication services, really Meta is the big dog in that area. Good solid earnings. Communication services is not all the way to the left and favored because of great performance. It's favored because it is losing less on down days. Just as important as positive performance. Financials, you've seen us adding to financials, both in US ETF and in tactical trend, trading very well for us. Financials include banks, insurance, broker-dealers, investment advisory firms, broad swath of industries within the sector, and I like the way they're trading. So we're overweight financials. Industrials, trading well for us. Hit a rough patch, a lot of concern about tariffs, but industrials trading well the last 10 days. Utilities is an area that we have to give more consideration to. We are underweight utilities, and I won't say it's hurt us, but it has been an area that's been overlooked. Just jumping to the other side, probably our best trade of the year, going back to January, was the sale of our energy ETF, XLE. We got a break, it got wind in its sails, ran right into stiff resistance in the 94, 95 area. We booted it. Today, last few days trading under 80, little bid today. We'll keep an eye and see how energy trades over the next couple of weeks. So that's really what we're thinking here, again, on the sector level. On the broad level, it's still large cap over mid cap over small cap. Mid has traded a little better. Small cap is sound asleep. And until some of the tariff and economic headaches can go away, there's still going to be an overhang on small cap. and it's primarily a flexibility issue. Small cap companies do not have multiple supply chains. Small cap companies do not have multiple lines of credit. Small cap companies normally do not have bulletproof balance sheets. So for the time being, that's been a tough slog. Small cap is represented in our portfolios. Fortunately, it's 5% or below. I hate owning 5% of it. As a matter of fact, probably our second best trade of the year in US ETF was taking small cap from 10 to 5% back in January when it got a little rally. But we do own it, and it's a drag on performance. And if you know me well, that irritates me 24 hours a day. Join us next week. We'll discuss some moves we made or are making, and enjoy your weekend. The Moose has some great bond information.
Thanks, Matt. It's John Musso. I'm the Chief Investment Officer at Cumberland Advisors. It is Friday, May 2nd in the morning, and this is the Bond Report. This week in bonds, another time, tale of two markets. Treasury yield somewhat higher this week. We had the 10-year bond basically move from a 424 up to around a 430, 431. So a little movement up really across the board in treasuries. Why? Well, we saw a stronger jobs number this morning. What was the expectation? The expectation was 138,000 jobs created, and with people almost downplaying it because of all the noise in the economy with tariffs, etc. What was the number? 177. So it was a good number, offset by the fact that we had revisions from the week before, which took it down about 45,000. So the net of it was a wash, but the market is focused on the fact that really the number was a fairly good jobs number versus expectations. On the other side, muni bond yields down. Maybe not down as much as they are right now, but you're looking at a 10-year AAA going from a 344 down to a 329. That's a pretty good movement in a week. Most deals that came this week saw significantly good demand with yields bumped. A couple of reasons why. One, we're seeing inflows into the municipal bond market. That is a shift from the last 4 weeks where I saw leakage out. This week we saw basically about $1.3 billion come into the market, into bond funds. Very positive. The other part of that is the fact that the noise level on treasuries has gone down. And that is a significant basically factor for the muni market, because with less noise in treasuries, it gives dealers the ability to hedge better, whether it's on a new issue that they're bringing to market or a older issue that they're bidding on. So the market technically is in much better shape, and we welcome that because we did go through a tough period, as you know, in the muni market, being buffeted by the tax talk. We've talked about that. That's gone away. Buffeted by tariffs, just like treasuries were. That has settled down. And of course, the noise about Jay Powell being fired from his job, and that's gone away. So I think the administration has taken its cue that less volatility is better than more volatility, and the noise level has quieted. As we go forward next week, we would expect to see real focus on inflation numbers. The PCE number this week was very good. Remember, that's the Fed's favorite measure of inflation. It was 0. The year-over-year numbers, still about 2.4. That is higher than the Fed likes. They want to see something below 2%. Does it mean that the Fed cuts rates? No, not now, but we expect them to cut later in the year because there are signs of weakening in the economy. The JOLTS number, job openings, that number was a lot less, versus expectations this week. And there's other signs that the economy is continuing to slow down, even in spite of the jobs number today. So we do expect the Fed to act, but later in the year and with a real watchful eye on inflation. As we close, we give you a Kentucky Derby pick for this weekend. Journalism, it is the favorite. Generally don't like to give favorites. However, horse has a great pedigree with, both Cumberland, who has won the Preakness years ago. Also, he won the Santa Anita Derby coming from behind. So even though we don't like favorites, that's our pick. We hope everyone has a great weekend, and we'll see you next week.